All right. So now we are going to talk about transaction with employees, some very, very specific issues which you need to have good understanding for you to determine the different elements of share-based payment arrangement. So what are these concepts, right? So vesting period. What's the meaning of vesting period? Period during which all specified vesting conditions are to be satisfied. Okay. So what does it mean? So what happens in any, you saw that, the shares will vest over a period of 3 years. 3 years, that's a service condition, is a vesting condition, right? Or a performance condition that you have to meet so much of profitability target or a revenue target, right? They are performance condition. That's also is a vesting condition, so on and so forth. So the vesting period is the period over which all the vesting conditions are expected to be fulfilled. All right. So now there are multiple dates, right, which are important here. So one is the grant date. What is the grant date? Grant date is the date at which the entity and the counterparty have full understanding of the terms and conditions of the arrangement, that there are no uncertainties left, that how many shares you are entitled for, at what price you are entitled for. Now, what are the conditions I need to fulfill for me to be entitled for this share-based arrangement, so on and so forth. So you are fully in know of all the terms and conditions in relation to the share-based payment arrangement on the date this is been achieved. That is called the grant date. Okay, that is like the inception of the share-based payment arrangement. If you look at a time scale, right? Now let's say it's a 3-year condition, that date that vesting condition for entitlement is satisfied. Let's say it's a service condition and you've satisfied that. And then year 4 to 10. So this is a grant date, this is a vesting date, and this is what is called exercise period. That means you can exercise any time between year 4 to year 10 after the vesting is fulfilled. Okay, exercise date when awards are exercised, could be any date between year 4, but you can't exercise before it vests. Okay, so whenever you will see the award which is granted, then awards which are non-vested, that means you're still going through the process of fulfillment of the vesting condition. So granted, non-vested, and then it got vest because now you fulfilled the vesting conditions. And then the exercise period. Many times what happens, the vesting date and the exercise date coincide. To say on the date it will vest, I will exercise now because I'm going to be rich, right? By so many shares. Okay. From that perspective, assuming there is a significant appreciation in the share price of the company over that period. If there is a decline, of course you won't exercise. That's the whole point, right? It's an arrangement which gives you an option. Okay. So different dates, there is a vesting condition. So we need to understand a vesting period is so this is the vesting period. Okay, this is the vesting period. Okay, which is over which you are required to fulfill the vesting conditions. Okay, so you have a grant date to the vesting date. Right, and then from vesting date to the exercise date, and this is the total life of the option, right? This is the total life of the arrangement. Okay, total life of the arrangement. And these are different for different types of arrangement. Some arrangement may lapse at 5 years, some may 10 years, some no, commonly we see 10 years, right? Is what is out there, but it is exactly between the employer and the employee, or between the two counterparties to agree to the terms of the arrangement. So what's a grant date? Grant date is defined as the date on which the company and the employee, right? Company and the employee agrees to the terms of an employee share-based payment plan. Now, at the grant date, the company confers on the employee the right to cash or shares of the company, provided the specified vesting conditions. Vesting conditions could be time-based vesting, or could be performance-based vesting, or could be market condition, and so on and so forth. If any being met, In practice, it is not always clear when a mutual understanding of the award has occurred. Issue of interpretation can arise, right, as to how precise the shared understanding of the terms of the award must be and exactly what level of communication. There could be some confusion at times, right? Not always. We don't see this, but these are some rare situation, between some senior employees and the company. There's some arrangements which are not very clear, right? So let's take an example and try and understand that when the grant date is achieved, okay, in those scenarios. Alpha Limited has announced a stock option scheme wherein it grants stock options to its employees. As per the scheme, 1,000 stock options are granted to its 300 employees. As per local regulations, 1,000 stock options are granted to 300 employees. Now, as per local regulations, okay, the approval of the board or shareholder is required. So approval of the board or the shareholder is required for the grant. Now determine the grant date in each of the following cases. The terms and conditions of the grant are first communicated to the employee. Post that the approval of the board or shareholder is taken, the approval is given by them with the same terms and condition as communicated to the employee. Okay, right? So we have to determine the grant date, right? So we have to determine the grant date. The company first gets the approval of the board and shareholder, and then the terms and conditions are communicated with employees. The company first gets the approval of the board or shareholder, and then the terms and conditions are communicated with employees. Okay. The terms and conditions of the grant are first communicated to the employees. Post that, the approval of the board or shareholder is taken. The approval is given by them after modifying some terms and conditions of the grant. Alpha Limited communicates the grant with the revised terms and conditions to the employee. So the question here is, what is the grant date in each of these scenarios? Now, the requirement is, the regulatory requirement is that the approval of the board and shareholder is required for the grant. So essentially the answer is that is the date on which you have all approvals in place in relation to the terms and conditions of the grant between the employer and the employee. So in this case, what will happen is the date of the board approval. Even though the board is approved without any change, doesn't matter, because the board could have changed, right? You don't know. So if the board has approved without change, good luck, right? But the date of the board approval is the grant date. The company first gets approval and then the terms and conditions is the date of the communication, because that is the date on which the employee is aware of the terms and condition, right? So there is a commonality between the counterparty. Both are on the same page, right? Now here again, the date of the communication, revised communication, right? Date of the revised communication. Let's look at the solution. Okay. All right. Grant date is the date at which the employee agree to a share-based payment arrangement. Employee entity and the employee agree. When the entity and the counterparty have a shared understanding of the terms and condition of the arrangement. If that arrangement is subject to an approval process, grant date is this is important, right? If that agreement is subject to an approval process, grant date is the date when that approval is obtained. All right. The grant date in each of the scenario will be as below. The date of approval by board shareholder will be the grant date in scenario number 1. Though the board and shareholder has already approved, the grant date in this case will be the date on which the grant is communicated to the employee. Well, I need to know what have you approved. I need to also agree with you, right? As on this date, right? And the third is grant date will be the date on which the revised and final terms are communicated to the employee after the board or shareholder approval, as this is the date on which Alpha Limited and the employees have the shared understanding of the stock option scheme. All right. So remember the principle. The principle is that when there is a common understanding between the employer and the employee and all approvals are in place, there is no uncertainty, right? There is no uncertainty in between the terms of the arrangement. That is the grantee. Recognition. Now, over what period? How do I record this, right? So, right, that's the, what do I record, right? Which we talked about, that the expense or the asset with the, that's the debit side, and then the credit side, and the timing is when goods or services are obtained, right? So date of rendering of services is when I need to record. Determine date on which the services are rendered is critical, and the company is required to recognize employee expense over the period of receipt of those services. I need to record this over the period of receipt of those services. Let's take an example. Recognition over a period, an entity issued share appreciation rights to existing employees who remains in service for next 3 years, and the benefit will then be settled in cash of an amount, equivalent amount of share price, right? So this I will record over a period because I'm going to receive services over next 3 years. So it's like a monthly charge which I will record for next 3 years. Recognize immediately, right? If let's say you are giving this benefit in result of your past actions, okay, or past contribution, a management of an entity decides to issue bonus amount based on share price of the entity to certain key employees for their past services, right? That means there is no obligation for in continuous employment. The amount equivalent to the shares will be recognized immediately at cost of employees because there are no conditions which are to be vested upon. These are vested shares which are given to those employees. Let's talk about the vesting and non-vesting conditions. Okay, we'll talk about the vesting and non-vesting conditions. So a share-based payment award generally vests upon meeting certain conditions, right? What are those conditions? Such as service condition, which is a time-based, or a performance condition, which is achieving a specified EBITDA target, or say a revenue target, or it could be any financial metric, right? Any financial metric which is being followed by that company. So it could be simply a time based. Most of the stock option arrangement which we see are a time based, okay? That if you continuously be in my employment for 5 years, you these many shares will vest to you, okay? They may vest what we call as bullet vesting, okay? Or bullet vesting means they will vest at the end of the 5 year, or they may vest on a staggered basis as well. That means they may vest every month, every quarter, every year, so on and so forth, on an accelerated basis from that perspective. So there are different types of, vesting scenario, right, which you need to be aware of. Now, the nature of the condition affects the timing of when the expense is recognized, and in some case, the measurement of the expense. The measurement may also change, and also over what period, how I need to record, that also change, right? And if a condition is not met, that means, let's say I'd given you stock options, right, and it was to vest if you were to complete or to be in my employment for a period of 3 years, let's say, and you decide to leave, right? Still people do leave, right? So you decide to leave, then that means you are no longer entitled for the stock options in a way, because you have failed to fulfill the vesting condition, right? Now in that case, the expense will be reversed, right? Not in all situations, only in cases where vesting conditions are not fulfilled, okay? Vesting conditions are not fulfilled, and there are situations in which it will not be reversed, even though you can't exercise the stock, and we will talk about that, right? That's where the standard becomes slightly more complicated, okay? Slightly more complicated. So if a condition is not met, whether or not the entity may reverse the previously recognized compensation expense, it depends on the nature of the condition that was not met. Depends upon the nature of the condition. So ordinarily, if it is linked to a service condition or a performance condition, and if these two are not met, then the expense will be reversed. If these two are met, okay, but award still not vest, or one of them met, depending upon, there was only one condition, like, but the award still not vest, then the compensation cost is not allowed to be reversed. Okay. Therefore, the classification of a condition is critical step in accounting for share-based payments, right? The classification of these conditions, okay, whether they are service condition or they are a performance condition or there are other conditions, right? Other vesting condition, and we will try and talk about. So there are vesting and non-vesting conditions, okay? So let's look at the non-vesting conditions. Such conditions which do not have any impact on eligibility to have which do not have any impact on eligibility to have share based payments. It has not been specifically defined by the standard. However, one can understand this as conditions which are other than vesting conditions. Okay, an example: ABC Limited has announced a stock option scheme for all its employees. The scheme requires that the employee is in service with the company for a 3-year period. Okay, that you have to be in service for 3-year period. Now, post the service period of 3 years, there will be a further period of 1 year within which ABC Limited need to reach a revenue of 150 million. So after 3 years, there's a further target of 1 year that you have to reach a revenue. However, as per the terms of the scheme, the employee will not lose its right to the stock option even if they resign after the end of 3rd year. Accordingly, the condition of revenue target in this case is a non-vesting. So if I am not required to provide my services to in a way earn that award or not to earn that award, then that is a non-vesting condition, right? Non-vesting condition. All right. So it's important for you to understand the distinction between the vesting condition and a non-vesting. A vesting condition is if it is linked to service, which is a time based, or if it is linked to performance. Okay, performance for which your employment is mandatory. Performance which is for which your employment is mandatory. Anything other than the service and the performance condition is a non-vesting condition. Okay, now if a vesting condition is not fulfilled, then the compensation charge, if you've recorded anything, will be reversed, right? If the vesting condition is not fulfilled. Now, if the non-vesting condition is not fulfilled, but the vesting condition in that arrangement, like in this arrangement was a 3-year service, if that's been fulfilled, but let's say in the 4th year, the performance targets have not been met, for which your employment was not required, now that's a non-vesting condition. Even though I as an employee, I won't be able to exercise the shares because the non-vesting conditions have not been fulfilled. The stock compensation expense is not allowed to be reversed. Okay, we'll further try and understand this with the help of examples. So XYZ Limited has granted a stock option scheme to its employees. Now, as per the scheme, the options will vest if employees complete a service period of 4 years from the grant date. 4 years from the grant date. The scheme permits the employees to exercise the options at any time after 4 years. Okay, permits the employee. So remember that chart time scale, right? So this is year 1. Then you move from year 1 to year 4, right? This is year 4. Okay, now and then you have year 10. Okay, this is year 10. So this is the grant date, this is the vesting date, and this is the exercise period. Okay, this is the total life. This is the total life of the option. Year 1 to 10 is the total life of the option. Okay, so the scheme permits the employee to exercise the option at any time after 4 years and on or before 10 years from the grant date. The company has carried out a fair valuation on the grant date. The fair value is INR 400,000, ignoring the impact of the vesting condition. Now, what is the vesting period in the scheme announced by XYZ Limited? What is the vesting period? 4 years, right? Simple. In this scenario, the option will vest to the employee once the once they complete a service period of 4 years, and hence it is a service vesting condition. Therefore, the vesting period in this case is 4 years. Simple. Okay. Vesting date is the vesting period is 4 years. Option can be exercised till the end of 10 years from the date of grant, and hence the exercise period is 6 years. Okay. And the life of the option is 10 years. Now, considering a vesting period of 4 years, XYZ will recognize an expense over the 4-year period, 100,000 each year for 4 years, divide by 4, okay? And corresponding credit will be to equity because it is a equity settled share-based payment arrangement. Had this been cash settled share-based payment arrangement, there would have been expense to liability, and then liability was also required to be trued up at every measurement. Now, this is important. Now, although after completing the 4-year service, if any employee does not exercise the option, then the expense already recognized cannot be reversed because you have already earned the award. Now, I as an employee now decided not to exercise, that's your choice. I as a company has already paid you the benefit. That is what I need to record as compensation cost. Now, if an employee leave at the start of the 3rd year, then XYZ will have to reverse the cumulative compensation expense booked over 2 years in relation to an employee, not for all employees, okay? In relation to the employee which has left the employment, okay? So, and that's what when you actually do the measurement, you factor in the attrition, right? You factor in the attrition, and then it's like a matter of accounting estimate, and then subsequently you true up that estimate based on actual experience. All right. So let's look at this example, vesting condition for equity settled share-based payment. So on 1st of January 2018, Success Limited has announced a stock option for its employees, provided they remain in service up to 31st of December 2020. So 18, 19, and 20. That means 3 years. The fair value of the option on 1st of January 2018 is INR 10 lakhs. Okay. Below is the expectation of Success Limited with respect to the employees remaining in service at the end of each year. 2018, 91%, 2019, 89%, and 2020 is the 82% actual, okay? All the employees to whom the shares are vested exercise their options, all right. What are the general entries to be passed by Success Limited over 3-year period? So I need to determine my total compensation cost, that is 10 lakhs. Now, out of which 10 lakh, only 91% are supposed to vest. Okay, that means 9,10,000 is my cost, which I'm supposed to record over a 3-year period. And then I will true it up in 2019, and then I will further true it up in 2020. Let's see how I'm going to record this. So December 31st, 2018, so 91%, 10 lakh into 91%, so that is 3,03,333. That means nothing but 9,10,000 divided by 3. That comes to this much. And then I have 89% means 8,90,000, right, divided by into 2 by 3, right, into 2 by 3, right. So that is what you will compute from that perspective. That's how you're doing the cumulative catch up. So I've already recorded 3. So my expense should be 593, and I've already recorded 303. So the difference 292 is 290 going to record in year 2 as well. Now in year 3, actual vesting is only of 82%, 18% in a way left. So my total cost will be 8,20,000, right? So 8,20,000 minus 593, which I have already recorded here, that 2,26,667 is the incremental cost I am supposed to record in year 3. Now, actual exercise, let's say, only happen for 75%, right? Now, this cost which you have recorded, you are not allowed to reverse. Once it's vested, you are not allowed to reverse, even though anybody, no, let's say not even a single employee exercise the shares, because the price of the stock crashed. Doesn't matter. Doesn't matter. All right. Once recorded, once vested, you are not allowed to reverse the cost of the share-based payment arrangement. Look at the journal entries: employee benefit expense debit to ESOP reserve, And then 31st December, employee benefit expense debit, same entries with the incremental amount, and similarly, incremental ESOP reserves, which is 8,20,000 to share capital on exercise. This you will do on assuming it has been exercised. Okay. All right.